Think Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. You know, it's a real treat when one of your really good friends and mentors swings by and you start talking about data that you need to determine, well, hey, what do I do in case of a recession? And, well, are we going to be in a recession? And what are some of these strategies and tactics around this? One of my really good friends, Neal Bawa, will be joining us in just a moment. And then we'll finish off the segment with some of the hottest zip codes for investing in real estate. If you're in some of these zip codes, maybe it's a good thing, maybe it's a bad thing, I don't know. You're going to have to figure it out. So we'll talk about a little bit of that too with Neal. I have a couple of questions for him about some different zip codes in different cities around the country, should we get to that. So it's a jam-packed informational segment today. It's going to be a lot of fun. And we can't just get started quite yet until we know who this show is brought to you by. Brought to you by Real Property Management. And Real Property Management is the largest residential property management franchise in North America, managing tens of thousands of properties for individuals, investors, and institutions throughout the country. You can learn more at realpropertymgt.com. Again, that's realpropertymgt.com. You can also call 888-806-7088. Again, 888-806-7088. Ladies and gentlemen, boys and girls, it is the captain speaking. It is time to bring Neal Bawa on the show. Neal, welcome.
Thanks for having me on the show. I've been, very excited to talk with you on the show, and I love the topic that we're going to talk about today.
Oh, same here. And you're the mad scientist of real estate. I mean, every time we connect, whether it's on the show, whether it's offline, on the phone, I mean, we'll end up talking for hours. And one thing that always, I love about you is your obsession over the right numbers, the right deal, does it make sense, and just data and interpreting data for the investor that wants to make money. So give us a little background on who you are, what you do, and we'll jump right in.
Sure. I'm a technologist, successful tech career, successful tech exit. I've always had a focus on data science. And I tell people that, data is the oil of the 21st century. If you were born in Texas 50 years ago, you couldn't help but be rich, but you had to still find oil, drill oil, and sell oil. But if you were to spend 60 minutes of your week, or maybe even 30 minutes a week looking at data, that is the equivalent of finding oil, drilling oil, and selling oil. And that's why I'm obsessed about telling more people just how easy it is to be rich and stay rich today, especially in commercial real estate, where this data is very readily available at a very low cost and has enormous consequences to your pockets and your investors' pockets. So that's really the core mission for me.
That's right. It's interesting to me that not enough people look at data to make decisions. It drives me absolutely up the wall. And it's like, especially right now, right? You have so many opportunities slinging by your email. Your emails, if our emails are very similar, it's just a deal. This one's good, this one's not, this one's good, this one's not. And many investors out there are making these decisions, are making buying decisions without looking at the necessary data. So we'll get to that in a second. There's this big topic about the recession and what's looming and what's not looming, and investors are getting scared and making dumb decisions or smart decisions, depending on what kind of investor you are. How do you know? How do you know what to do in a recession?
Well, I think that the first thing to do is to change your mindset and say there will be a recession, right? So there's nothing wrong with preparing for a recession that doesn't arrive.
Yeah.
Because you haven't done any damage to anything, right? So if it doesn't arrive, nothing bad will happen simply because you prepared for it. So the first thing is your mindset needs to be, there's a recession coming the next 12 months all the time, right? So you should be thinking that all the time. And number two is that you have to understand that you have to really stay away from the bullish nonsense that goes on the internet, right? So whenever somebody tells you something like real estate does really well in a recession because people need somewhere to live, or multifamily will do really well in a recession because people will lose their homes and they will run away from Class A and go to Class C, that's the kind of nonsense you want to stay away from, because it's going to prevent you from taking action. It's going to prevent you from preparing. Let me tell you what really happens. Real estate does worse in a recession than most asset classes, because most of America that lives in apartment complexes only has $300 to $400 in their bank. That is the average amount of money in people's banks. And when their hours are cut in a recession or they lose their job, there's a very high delinquency spike. So it's possible that you might actually have a higher occupancy because all those people that are losing their homes and all those people that are no longer able to afford Class A's are probably going to be running towards you. But keep in mind, some of the people in your Class C's are going to be running towards mobile home parks or mom's basement or their car, living in their car.
Yeah.
So it's both ways, right? So you really can't gain.
Yeah.
So number one, accept the fact that if you look at the data for 2008, 2001, 1991, pick a recession, you're always going to see a decline in profits. But that is not a reason not to buy real estate today. And I'll tell you why in a few minutes. But first, I want to address this question of what do you do to prepare for it?
Yeah.
Well, number one, mentally prepare yourself that things will get worse. Your job, if you're managing real estate, regardless of whether you're managing 2 units or 2,000 or managing 2,000 units, is simply to accept that and say, what are the things that I could do to prepare? So number one, accept that there will be problems. Number two, start really plugging yourself into what is happening in the marketplace. Don't be caught. Don't be the last one to know that there's a recession. And I'll tell you how to do that in just a second. This is a magic bullet. I'm going to give it to you. Recessions are actually declared later after they happen. So the Federal Reserve says if we had negative growth in the U.S.
And
for
that's
2
GDP.
successive quarters, GDP
Yes.
growth,
Yeah.
right? Negative GDP growth for 2 successive quarters, then it's a recession. What does that mean? Well, that means is if you have 1 quarter of negative GDP growth, you, the guy that's managing real estate, needs to start assuming that the recession has started. Don't wait for another quarter to go by because then you are the last one to know. Because by that time, lots of bad things have happened.
Yeah.
So if you get 1 quarter of negative GDP growth, assume that and start taking actions. Don't be overly bullish on your cash flow situation. Second, if you're distributing to investors, stop those distributions. Send them an email saying, we had a negative quarter of growth. Right now, our focus is on preservation of capital. We're not looking to basically give you returns. We're looking to preserve your capital. We're looking to be in the best possible situation.
Yeah.
We're going to take your cash flow and we're going to put it into a war chest. And we're going to keep building up that war chest every month for the next 3 months, and we'll watch to see if there's positive growth. If there's negative growth, we keep building it up further because our property is making profits right now. We have all this cash flow. We're going to build this war chest because if something goes wrong, then our focus is not on rehabbing units. Our focus is not on raising rents. Our focus is on keeping our tenants.
That's right.
Second, I want you to then spend the next 3 months building a community. You want to really, really get tight with your tenants. Spend more time making them feel like they're in a community. Spend time on hot dogs. Spend time on Christmas events. Bring in city officials talking about back to school events. Do all of those things that tie people emotionally to your community because 3 or 4 months from now, they might have to make a decision. And you want to make sure you bias that decision now. They want to think, oh my God, I don't really want to move from this place. I love it. Look at all the things that they do.
The other tenants, the management, they're fantastic. The people, they care.
God.
Absolutely.
Right.
Yeah.
Right. So let me just take some of my savings. I'm going to basically do this, sell that, or whatever it is, borrow money from my dad, but I want to stay here. I don't want to leave. So you have this 3-month time frame to actually prepare. And then mentally prepare your investors, right? Tell them, and they will love you for it. They will love you for it. Don't lie to them. Tell them we think a recession may start. We think that there's a 60 or 70% chance. The good news is, and tell them the good news too, and tell them we know the Federal Reserve's playbook. They're going to cut interest rates, and they're going to flood the market with liquidity.
Yep.
And when we come out of this recession 6, 9, 12 months from now, that's going to be bullish for you. Because I'm going to be holding property where interest rates are much lower. So whoever is going to buy our property can afford to pay us a lot more, can't he? Right? I mean, think about it. It's huge difference,
1,000%.
right? So if interest rates were 4.5% a year ago and today they're at 3.5%, if they drop to 2.5%, the next guy can pay millions more for the property.
That's
so
right.
the best thing that I can do right now is hold my property, maintain my net operating income. I don't have to increase it because the Federal Reserve of the United States is increasing my profit.
That's right,
because
by lowering those rates.
Lowering those rates.
Exactly.
I don't need to shoot for the sky.
Right.
So your approach needs to change from for the sky to I need to stay where I am.
So,
I need to keep my tenant base.
Right. So really, I'm looking at efficiency and stabilization, right? Whenever there's any type of market that you feel is topping out, and you're looking at the GDP over the last quarter, and let's say that the GDP is negative for last quarter, start to work on that stabilization, right? You need efficiency, stabilize your property, make your freaking tenants happy, do whatever you got to do, because that's super, super important.
Exactly, and switch your approach. So when we buy these multifamily properties, our primary approach is keep raising rents, almost forcing tenants to leave, right? That can't afford it, and then rehab that unit and rent it out for a higher cost. I urge you, if there's a negative quarter of GDP growth, stop doing that. What you want to do at that point in time is immediately stabilize your rents, keep your tenants, and sign longer leases. So instead, start giving them incentives to sign 15, 16, 17-month leases, as opposed to trying to keep them less so you can kick them out and rehab their unit and lease it up. Because during a recession, even if you rehab that unit, you're not going to get $1 more for it.
1,000%. I mean, you might as well do a 15, 16-month lease, maybe throw in 1 month for free or something.
For free, something like that. It's like if they pay on time for the next 6 months, they get a month for free at the end. Something that basically incentivizes them to stay. So your goal is really going to go from maximize profit to maximize stability. And that is the way to get through a recession. Your profit will be automatically maximized by the Federal Reserve when they cut interest rates. Those interest rates you can't use right now because the value of your property is going to fall. But when the recession ends and things go back into an upturn, those rates will still be low for a long time. We've had them low for 8 years. Now you have all that time to maximize your profit.
That's right. So what do I do? What's the playbook then if GDP is positive, right? Last quarter, positive, boom, positive, and we're not in a recession. What do I do then? Keep rehabbing those units and charging more rent?
Well, so the answer is I believe that right now we've got to slow down. We cannot ignore what is happening in the marketplace. Please think about this. In the history of the United States, we've never had an instance where we had under 4% unemployment and the Federal Reserve cutting interest rates. You have got to read what is happening. There is extreme weakness outside the United States in the Eurozone, Japan, and in other markets, Asian markets, and that is dragging the U.S. down. We do have a strong economy, but we are going to get dragged down by the rest. So the chances of a recession are very high at this point of time. So what I would do is I would not embark on extremely aggressive, rehab projects. I would not embark on buildings that are at 50%. So even though the GDP is positive, right now, you've got to accept the fact that the second half of 2019 and the first half of 2020 doesn't look like the last 12 months. It doesn't, because the Federal Reserve is not a stupid organization. They're seeing some problems in the future, which is why they cut interest rates.
That's right.
And now they're talking about cutting interest rates again in September, again in December. So understand that they see something coming and understand that it's not good for you in the short term. So become risk aware, even if GDP is positive.
It's really, really funny. In January, the Fed said, nope, we're not cutting interest rates at all. We're doing absolutely nothing with interest rates. And I called and I said, there's no way that's possible. There's zero way. You can even see this on my Twitter feed, on my LinkedIn feed. It's nuts. And I said, you're going to be cutting rates. I guarantee you're going to be cutting rates. There are all these real estate folks that are like, what are you talking about? They already said this is what they're not going to do. But guess what they're doing? They're cutting interest rates. So like Neal said, pay really, really, really close attention to major headline news and then pay attention to what's going on. Neal, we have like 2 minutes left, and I know you got to go, and I have to keep doing this thing. Multifamily's in a bubble. Real estate values are too high. Yes, no. What do I do about it?
I don't think multifamily is in a bubble. I think that multifamily syndication possibly is in a bubble because we have a lot of operators that are brand new that are coming in and driving up prices through syndication. Multifamily itself, I think, is priced for perfection. It's the step before a bubble. I think that we could go into a bubble. I think that we might go into a bubble if we have a recession, because if interest rates drop to 2.5%, everybody and their mother will want to buy multifamily. The reason it's not in a bubble is the world economy. There was a Denmark bank that 2 days ago basically started giving out negative mortgages, right? The mortgage basically below 0% interest. And that's happening all across the world. And when when yields worldwide are falling below zero, but in the US they are positive and real estate is still producing double digits,
Yep.
we look extremely attractive. So we cannot be a bubble when we have double-digit returns and the rest of the world is at zero. Well,
Yep.
their money is going to keep coming in. Therefore, multifamily is not in a bubble yet.
Yet. I like it. But multifamily syndication, and we talked about this as well a lot offline, multifamily syndication in and of it, that itself is in a bubble. Like if you've done 2 successful flips and all of a sudden you're raising a $10 million fund. Like, oh my gosh, I just don't get it. Anyway, Neal, we could keep talking about this forever. I certainly want to thank you so much for your time and insight. What's the best way to reach you at Grocapitus?
The best way is actually to reach me through my training website, multifamilyu.com. Once you go there, you'll find 10 different ways to see me. You'll also find over 50 webinars, all free, about multifamily, single-family real estate. One that I recommend, if you're really interested, is how the banking system changed real estate forever. So check that one out.
Awesome. Will do. Neal, thanks so much. I certainly appreciate the time and insight as well. Think Realty Nation. This next segment here is brought to you by Narada Real Estate Investments, your premier source for turnkey cash flow investment property. Visit www.turnkeyrealestateinvestments.com. We're talking about the hottest zip codes to be investing in. And real quick, this is kind of interesting to me. This is a Q1 2019 home flipping report from Adam Data Solutions. Said 8 out of the 10 zip codes with the highest home flipping rates were more than 30%. Leading list was zip code 93212, located in Kings County, California, with a flipping rate of 48%. So it's kind of interesting to take a look at. In this top California zip code, real estate investors, quote, purchased homes for a median price of $72,500 and then sold these homes within 12 months for a median price of $112,500, almost doubling that initial investment. Following this list is a zip code in Queens County, New York, 11433, with a flipping rate of 35.7%. And we also have Miami-Dade County in Florida, got Shelby County, Tennessee, Orange County, California, and closing out this top 10, Knox County, Tennessee. So Tennessee, I can kind of see. I mean, like there's so much activity in the Nashville area and just Tennessee in general. So I can see why 37917, that zip code made that top 10 list. And then, of course, St. Louis, Missouri, 63033. I used to live in St. Louis and, of course, Winsfield, Missouri. And St. Louis, Missouri, I mean, a lot of great little kind of brownstone units, and you also have these brownstone units with these amazing modern renovation style jobs that folks are doing there as well. So I like this top 10 list, but keep in mind, again, it's a good thing and a bad thing. Think Realty Nation, that's a wrap. But before we leave, you need to know that this show was brought to you by Real Property Management, which is the largest residential property management franchise in North America, managing tens of thousands of properties for individuals, investors, and institutions throughout the country. You can learn more about them at realpropertymgt.com. That's realpropertymgt.com. You can also give them a call at 888-806-7088. Again, 888-806-7088, and let them know Abhi said hi. Until next time, Think Realty Nation, happy investing.